This is NDTV, and you're watching NDTV Profit.
Hello and welcome to the special interview here on NDTV Profit. We're living in a fast-changing economic environment, and we're getting a view today on the economy, the interest rate scenario, and of course also banking with Mr. Aditya Puri, MD of HDFC Bank. So thanks so much for speaking with us.
Welcome.
Let me just start by asking you, we've had a few days after the vote on account where not much was expected, but the one big thing that came out was a concern about the government's finances, which indirectly, of course, has an impact on the overall macro and the interest rate environment. From a banker's perspective, how did you view all of those announcements coming out about deficits, about market borrowings?
See, the fact of the matter is you can't expect the government to come up with magic. Given the circumstances that have happened globally, and if you are required to push expenditure to promote growth, deficits are bound to increase. And we will have to look at a revised basis on which, and that we look at deficits. And that's what's happening globally. And a lot of this was actually anticipated. I mean, this has been talked about for a long time by Mr. Ahluwalia in terms of what will happen, what the purpose it's being used for. And the good part is that it's been used for good purposes. There is a safety net. And if it's used for infrastructure spending, which is productive, I think it's money well spent, and we probably don't have an option.
But sir, I mean, yes, money well spent, but it's sort of complicating the environment right now, isn't it? I mean, productive purposes to an extent, but there was also money spent on the farm loan waiver, on the pay commission, all of this which is adding to a record high market borrowing at a time when, anyway, private players are not getting enough funding. Is this crowding out private borrowers to an extent?
Yes and no. Let me cover the funding aspect. As things stand today, there is enough liquidity in the system. Banks are probably placing about 50,000 crores in reverse repo at 4%. So I don't think liquidity is a constraint, at least in terms of short-term funding. Banks have a problem in terms of garnering enough resources for long-term funding because we are subjected to SLR and CRR. On CRR, we get no interest, and SLR, we will probably earn less than what we pay on the deposit, so the price becomes too high. So short-term funding, enough is available. Long-term funding, yes, there could be some crowding out of the private sector. But there again, I think they're probably having a wait-and-watch attitude based upon the overall uncertainty. And to some extent, if you do want to generate demand, you will have to spend on employment generation and other activities where you have to look after people at that strata of society.
So the fact that the longer-term yields have hardened, is that a negative factor? Because there are those bankers who have told us that they're waiting for the yields to be consistently low, perhaps come down and stay stable at those lower levels before they're comfortable cutting rates. Is that a fair argument, and is that complicating it for you as well?
Well, let me put it this way. I don't think that the reduction in rates is dependent upon just the yield on government securities. I think the reduction on rates today is more dependent upon a reduction in deposit costs, far more dependent. And so I don't buy that argument. The issue in terms of interest rates coming down faster than what they have been coming down is the deposit rates. And the deposit rates are high because you get 8% on small savings and you get about 6.75 on mutual funds because of the tax arbitrage. And till the costs come down, we must understand that for monetary policy to be transmitted into the real economy, the deposit costs have to come down. Just the indicative policy rates are not enough. They account for probably 5% of the funding.